Imagine running a lemonade stand, right? Where
Yeah.
the actual number of cups you sell it stays exactly the same all summer long.
Okay, I'm picturing it.
Yeah. But somehow your take-home profit still jumps by like 12%.
Which, on a fundamental level, shouldn't be mathematically possible.
Exactly. You sell the same amount of product, you should make the same amount of money.
Huh.
But right now, one of the biggest industrial companies on earth is proving that elementary school arithmetic, it just doesn't always apply.
It definitely doesn't apply when you reach the scale of, well, a multi-billion-dollar global conglomerate. The physics of finance, they change entirely at that level.
Right.
Growth stops being just this visible expansion of a business,
Yeah.
selling more cups of lemonade, and it becomes an exercise in radical internal efficiency.
And that is exactly what we are exploring today with you. We've got the first quarter 2026 earnings conference call presentation and the April 30th press release from Illinois Toolworks, or ITW.
ITW?
And for those who aren't familiar, I mean, ITW is a massive powerhouse. They make everything from heavy welding equipment to commercial food hardware to, like, automotive parts.
Right, because their products are the literal nuts and bolts of other industries. Looking at their numbers is essentially taking the temperature of the global economy.
Our mission today is to decode all this dense financial jargon, right? And uncover what is basically a masterclass in how a business can squeeze out double-digit profit growth even when actual product sales are, well, practically flat.
It's a fascinating case study. When ITW speaks, you really get a direct read on the physical pulse of the world's supply chains. It tells you what companies are actually doing with their money, not just what they say they're feeling on those consumer confidence surveys.
Yeah, totally. So let's start with the big headline they put out for Q1 2026, because it really sets up the paradox we're going to pull apart today. ITW reported that total revenue hit $4.02 billion.
Okay.
And on the surface, they are claiming a solid 5% increase from the previous year. You see that and you think, great, the business is 5% larger.
But see, this is where you have to separate the illusion of growth from the reality of operations.
Okay, unpack that for us.
Well, analysts look past that top-line number and they focus on something called organic growth. That metric strips out all the financial noise and basically asks, did you actually sell more of your own goods, or did you just raise prices on your core products?
Right.
And out of that 5% total revenue increase, ITW's organic growth was actually only 0.4%.
Wait, 0.4.
Yeah, 0.4%. It was essentially flat.
Okay, wait, so if organic growth is basically flat, it's like throwing a dinner party and bragging to everyone that you have 5% more food this year.
Exactly.
When really you just bought like a smaller table to make it look crowded, and the exchange rate made your imported French cheese look mathematically more expensive on paper. You didn't actually bake a bigger cake.
That is exactly what happened. The vast majority of that 5% growth, about 4.2% of it, actually came from foreign currency translation and acquisitions.
Ah.
Yeah, so if the US dollar weakens against the euro, for example, the sales ITW makes in Europe suddenly translate into more dollars on their balance sheet here, even if they didn't sell a single extra widget.
Oh, that's wild.
And to be perfectly accurate, their total growth was actually dragged down by roughly 1% due to some ongoing impacts from their polymers and fluids segment and some issues in the Middle East.
So the big driver of the quote-unquote growth was really just currency exchange rates working in their favor and buying up other revenue streams.
Precisely. Actual demand for physical goods is relatively stagnant.
But here is the central mystery we need to solve today. Despite that essentially flat organic sales growth of 0.4%, ITW delivered a GAAP earnings per share of $2.66.
Right, which is huge.
Yeah. And GAAP just means this is the official, strictly regulated accounting math, right? No creative bookkeeping allowed. So that $2.66, that is a massive 12% increase in earnings.
And this is the core of their entire strategy. How do earnings jump 12% when actual sales only go up 0.4%?
Exactly.
The answer lies entirely in their operating margins. In Q1 2026, ITW actually increased their operating margin by 60 basis points, bringing it up to 25.4%.
Okay, and for context, a basis point is just 1/100 of a percent.
Correct.
So 60 basis points is a 0.6% increase. It sounds like a rounding error, honestly. But when you are dealing with over $4 billion in quarterly revenue, squeezing an extra 0.6% margin out of the machine, that means tens of millions of dollars in pure profit falling straight to the bottom line.
Tens of millions. Because of that margin expansion, their total operating income reached $1.02 billion, which is a 7% increase. Yeah, and in the press release, CEO Christopher A. O'Herlihy specifically points to what he calls their disciplined, quote, do what we say execution.
Do what we say execution.
Yeah, he notes that their enterprise initiatives contributed 120 basis points to the margin expansion alone.
Hold on, though. I have to push back here. Enterprise initiatives and do what we say execution. I mean, we see this corporate speak all the time.
We do.
Isn't this just a very polite slide deck way of saying they are firing people, shutting down factories, and like turning off the lights in the break room? Usually when a company brags about initiatives saving the money on flat sales, it's just ruthless cost cutting.
It's super easy to assume that, and honestly, at a lot of legacy companies, you'd be right. But ITW's approach is structurally different.
How so?
If you look closely at their segment slides, particularly the automotive OEM segment, they detail the specific mechanics behind these initiatives. They highlight two main drivers, strategic sourcing and 80/20 FTB, which stands for front to back.
80/20.
Mhm.
Like the Pareto principle, where
Ye-
80% of your results come from 20% of your effort.
Yes, exactly. But they don't just use it as a motivational poster in the hallway, they have institutionalized it into their manufacturing process.
Okay.
Imagine a factory floor that makes 10,000 different types of industrial fasteners.
10,000. Got it.
The 80/20 principle dictates that 2,000 of those fasteners are generating 80% of the profits.
Right. The core products.
Right. So the other 8,000 types are niche. They're like a very specific screw for one specific machine that a client orders twice a year.
Ah, okay.
They require the factory machines to be constantly stopped and retooled. They require different packaging, special marketing, and they just sit in warehouses gathering dust for months.
Which means those 8,000 niche products are actively dragging down efficiency.
Exactly. Even if those niche products bring in revenue, they destroy profit margins because of all the complexity they add. So ITW aggressively prunes those low-margin products. They systematically go to clients and say, well, we no longer make this custom piece.
But wait, doesn't that cause massive friction? I mean, if you cut a product that a legacy client relies on, don't you risk losing the client entirely or at least taking a hit to your top-line revenue?
You absolutely do risk that, and they accept that trade-off.
Really?
Yeah. Shrinking revenue to expand margin is one of the hardest psychological pills for corporate management to swallow, which is why true 80/20 execution is pretty rare. Most executives are just addicted to top-line growth.
Right. The bigger the revenue, the better the bonus, usually.
Exactly. But ITW is willing to sacrifice $1 of complex revenue to gain 50 cents of pure profit. Once you drop those 8,000 complex SKUs, you need fewer warehouses, less supply chain management, and your machines run continuously without expensive retooling downtime.
That makes a lot of sense. And what about the strategic sourcing part of the initiative? What does that mean?
Strategic sourcing just means leveraging their massive simplified scale. Once you pare down your product lines, you are buying fewer types of raw materials, but you are buying them in much larger quantities.
Oh, bulk discounts.
Right. You go to your suppliers and negotiate better rates because your orders are massive and predictable. You combine that cheaper raw material with the stripped-down factory floor, and suddenly your cost to produce goods drops dramatically.
Wow.
That is how you squeeze $1.02 billion of profit out of a stagnant market. It's a highly targeted surgical operation.
Okay, so they've clearly mastered cutting the fat. But, I mean, you can't cut your way to infinity. If they're surviving on peak efficiency, what are they actually selling to keep the lights on and drive that 0.4% organic growth? Like, where's the world actually spending money right now?
To find that out, we have to look at what the CEO highlighted regarding CapEx-related segments.
CapEx meaning capital expenditures.
Exactly. They are seeing a surge in demand from companies actively opening their wallets for big physical infrastructure investments.
The picks and shovels of the modern economy.
Exactly.
So let's look at the standout segments there. First up is the welding segment. It brought in $507 million in revenue with an organic growth rate of 6%.
Which is strong.
Yeah, but the really telling number is inside that segment. Equipment sales jumped by 8%. While everyday consumables were only up 2%. Why is that gap between equipment and consumables so important?
That gap is the ultimate tell for the global economy. If a factory is just experiencing a busy season, they run their existing machines harder, which means they burn through more consumables.
Things like welding wire and protective gas.
Right. But an 8% surge in heavy equipment compared to a tiny bump in consumables, that means these companies aren't just running old lines. They are physically building entirely new assembly lines and expanding their footprints.
They are buying the massive, multi-million-dollar machines that you only buy when you are laying down new infrastructure.
Exactly, and we see this mirrored in their test and measurement and electronics segment.
Oh, yeah.
That segment hit $715 million in revenue, up 5% organically. And within that, the electronics division alone surged by 10%.
So, connecting the dots here, if companies are buying huge amounts of heavy welding equipment and highly technical electronic testing gear, it paints a very clear picture. It means industrial and infrastructure investment is highly active, regardless of what the broader news cycle might suggest.
This is exactly why analyzing internal data from a company like ITW is so valuable. If you only look at consumer retail spending, you might think the economy is slowing to a crawl.
Right.
But ITW's order books prove that major corporations are spending heavily on the heavy machinery required to build the future. The industrial base is expanding, even if the consumer base is feeling the pinch.
Which provides a perfect transition into the parts of ITW's business that are consumer adjacent, because the contrast here is starting to get really stark.
It really is.
Let's look at their automotive OEM segment, the original equipment manufacturers. Their organic revenue is actually down 1% globally. In North America, it's down 5%, and in China, it's down 3%.
Yeah.
People are clearly buying fewer cars, and auto manufacturers are ordering fewer parts.
It's a noticeable slump in volume.
Yet, incredibly, their operating margin in that specific automotive segment jumped 170 basis points to 21.0%. They are selling significantly fewer car parts, but making vastly more profit on every part they do sell.
It's wild.
And it's not just automotive. Look at their food equipment segment. Organic revenue there is down 3%. But again, their margins went up 150 basis points to 22.9%.
It's the 80-20 principle in full effect. The volume drops, but the efficiency skyrockets.
But I have to push back on this strategy in the long run. At some point, if North American auto sales just keep dropping 5% year after year, no amount of strategic sourcing or pruning is going to save you. Eventually, you actually have to sell more widgets, right? If your core market is shrinking, there has to be a floor to how much you can optimize a factory before you just run out of revenue.
You're hitting on the core vulnerability of the strategy. And honestly, ITW's management knows it. They know they can't control the macroeconomic cycles. Auto sales will slump, restaurant equipment upgrades will stall.
Right.
But this is where their forward-looking projections for 2026 become so revealing. They have an explicitly stated goal. They are, quote, on track for a positive margin impact of approximately 100 basis points in 2026, independent of volume.
Independent of volume. I mean, that is an incredibly confident thing to put on an official slide deck for your investors.
It is, and it proves that they have intentionally engineered a business model designed to absorb these cyclical shocks. They aren't trying to shrink to infinity. They are telling investors, look, we accept that the world will occasionally stop buying as much of our stuff. But instead of panicking, slashing prices, and destroying our brand just to artificially boost our sales volume, we are going to tighten the internal screws. Our machinery is so highly tuned that we guarantee we will extract an extra 1% of pure profit out of whatever baseline volume we do manage to sell.
That's fascinating. So let's take all this historical Q1 data and their philosophy and project it forward. Let's look at their 2026 blueprint. With auto sales down and organic growth nearly flat, how confident are they in this model holding up for the rest of the year?
Extremely confident. Based entirely on this Q1 margin performance, ITW actually raised their full-year GAAP EPS guidance by 10 cents. They are now projecting earnings per share in the range of $11.10 to $11.50.
Okay, and what are they targeting for total revenue for the year to justify those earnings?
They are targeting in a total 2026 revenue of $16.3 to $16.6 billion. But the metric that truly illustrates the health of this company is their projected after-tax ROIC, or return on invested capital.
Right.
They are projecting an ROIC of over 30%.
We need to underline how huge that is for you listening. Return on invested capital basically measures how good a company is at turning cash into more cash.
Exactly.
If they take $1 and invest it back into their own machinery, software, or supply chain, they're generating a 30% return on that dollar.
Which is incredible.
Yeah, when corporate borrowing costs might be sitting around 5 or 6%, generating a 30% return is elite efficiency. That spread between the cost of money and the return on money is pure value creation.
It puts them in the top tier of industrial companies. And because they generate such a high return on their operations, they are flush with cash. In just the first quarter, they generated $500 million in free cash flow.
And free cash flow is exactly what it sounds like. It's the cash left over after the company has paid for all its operating expenses and capital expenditures. It's the money they can actually use to reward shareholders.
Yeah.
And what are they doing with that $500 million?
They are channeling it directly into share repurchases. They are planning for approximately $1.5 billion in share buybacks for the entire year.
Which is the final piece of the profit puzzle. When a company buys back its own stock, it retires those shares. It reduces the total number of slices in the pie.
Yeah.
So even if the company's overall net income doesn't grow a single dollar, the earnings per share, the EPS, still goes up because you are dividing that same income by fewer outstanding shares.
Yeah.
It artificially engineers a higher value for the investors who hold on.
Exactly. It's the ultimate lever to pull when top-line revenue is flat.
It makes me think of a sailboat out on the open ocean. When you are sailing, you absolutely cannot control the wind. The wind is the macroeconomic environment, consumer demand, inflation, global auto sales. Sometimes it's blowing at your back and sometimes it dies completely.
Right.
ITW can't force people to buy more cars. But they don't just sit there waiting for the wind to pick up. They are absolute masters at trimming the sails. The enterprise initiatives, the 80/20 pruning, the strategic sourcing that's them pulling the ropes tight and reducing the drag on the hull.
I like that analogy.
And the share repurchases. That's them systematically making the boat lighter. They reduce the overall weight of the outstanding shares so that even with a light breeze, the remaining shareholders still move forward faster than anyone else. They are guaranteed they win the race, regardless of the weather.
That is the perfect way to visualize it. They control the controllables.
Huh.
And if we step back from the billions of dollars and the heavy industrial machinery, there is a fundamental lesson here that connects directly to you.
Absolutely.
Whether you are running household budget, managing a small local business, or reviewing strategy for a corporate division, ITW proves that operational discipline is often a far more powerful tool than relying on endless revenue growth. We are conditioned by modern business culture to think that earning more money strictly requires making more, selling more, and constantly expanding our footprint. But true financial resilience comes from ruthlessly maximizing the efficiency of the footprint you already have.
It's working smarter, pruning the dead weight, and letting the margins do the heavy lifting. So to wrap up our analysis today, ITW's first quarter of 2026 is far more than a standard financial update. It is a blueprint for how to squeeze a 12% profit growth out of practically flat sales.
Right.
They achieved it through rigorous, unsentimental margin control, leveraging the 80/20 rule to eliminate complexity, and smartly capitalizing on the industrial infrastructure boom in things like welding and testing equipment, even while their consumer-facing sectors slowed down.
But as we close the books on this, it leaves us with a lingering, somewhat provocative question to ponder.
Okay, let's hear it.
We've seen how brilliant this 80/20 margin-focused strategy is for ITW shareholders. They're extracting incredible value without needing to grow their output. But if massive foundational corporations like ITW are perfecting the art of maximizing their profits without needing to actually increase the physical volume of goods, they produce what happens to overall global economic growth when every major company decides that internal efficiency and margin expansion is far more rewarding than actual physical external expansion.
Wow, that is the real corporate magic trick, isn't it? Making the profit appear without ever expanding the hat.
Exactly.
But at what point does the economy stop growing and just start optimizing? Thank you for joining us on this deep dive. We hope this helped you see the hidden mechanics operating just beneath the surface of the numbers, because being truly well-informed means knowing exactly where to look when the math doesn't quite add up. Catch you next time.